Welcome to The Explainer. Today, we're digging into a huge concept in finance, credit risk, but we're going to look at it from the bank's point of view to really understand what's going through their minds every single time someone asks for a loan.
I mean, you've probably wondered this, right? You hand over all your paperwork, you fill out all the forms, and then you just wait. But what are they actually doing? What's the one big question they're trying to answer? Well, that's what we're here to figure out. Let's jump in.
You can think of any loan at its core as a kind of formal handshake. It's an agreement. And while it might look simple, you've got two parties coming to the table, and each one wants something very specific out of the deal.
And on the surface, it's pretty straightforward. The borrower, that could be you, a small business, a huge corporation, needs cash. The bank has the cash, and in exchange for lending it out, they earn interest. That interest is how they pay their bills and hopefully make a profit. It really seems like a perfect win-win situation, doesn't it?
Well, this is where things start to get tricky. See, for that handshake to actually work out, the bank has to believe that the borrower is going to hold up their end of the bargain in the future. And that means the bank basically has to try and predict the future.
So what's their crystal ball? It's your financial history. They do what's called an ex-ante analysis, which is just a fancy way of saying before the event. They look at everything, your income, your spending, what you already owe, your entire cash flow, really. And they use all that to make an educated guess about whether you can make those payments down the line. Which brings us to the million-dollar question. After all that work, all that analysis, can they ever be absolutely 100% sure you're going to pay it all back? The short answer? Nope, not a chance. There's always a question mark.
So why can't they get it perfect? Well, for starters, they're using your past to predict your future, which is always a bit of a gamble. But the bigger issue is that the world can change in the blink of an eye. The economy could tank, you could unexpectedly lose your job, whole industries can get turned upside down. There are just so many things that are totally out of your or the bank's control.
And this big, looming uncertainty, it has a name. In fact, it's the one thing that probably keeps bankers up at night, and it's the idea that shapes the entire world of lending.
And there it is, credit risk. Sometimes it's called default risk. It's simply the possibility that the promise made in that original handshake might get broken. And pay attention to those words cannot or will not, because it covers both. It's the risk that someone is literally unable to pay, and also the risk that they just choose not to.
Now, this isn't just some vague worry for the banks. They work really hard to turn this possibility into a cold, hard number. They actually calculate the statistical probability of default for every single loan, and that number is crucial. It helps them decide if they should lend to you, how much, and what interest rate they're going to charge.
Okay, so if banks know they can never be totally certain, what do they do about it? They don't just cross their fingers and hope for the best. They build a safety net, and it's got a couple of different layers.
This safety net really has two parts. You've got your preventative measures. These are the things the bank does up front, before there's a problem, to make the loan less risky. And then you have palliative measures. These are the things they do to cushion the fall after someone has already stopped paying.
Let's talk about the preventative stuff first, because these are the things the bank asks for from you, the borrower. The most famous one is collateral. That's an asset, like your house or your car, that the bank can take if you stop paying. They might also ask for a third-party guarantee, which is basically getting someone to co-sign the loan and promise to pay it if you can't.
All right, now for the other side of the coin, palliative measures. These are things the bank has to do internally. They're actually required by law to take some of their own money from their capital or profits and set it aside just in case loans go bad. Think of it like the bank's own rainy day fund, built specifically to absorb losses so that a few defaults don't sink the whole ship.
So they've done their homework, they've got collateral, they've got their emergency fund ready to go. Problem solved, right? The risk is gone? Well, not exactly. And this leads us to the most important takeaway of all. This quote from our source material really nails it. It says that lending will always be subject to these problems. But you see that new phrase in there? Asymmetric information? What on earth is that? Asymmetric information is the real reason the risk never fully goes away. All it means is that one person in the deal knows more than the other. And in this case, you, the borrower, will always know more about your own financial life, your true intentions, and your ability to pay that loan back than the bank ever could. You've got the inside scoop, and they're always on the outside looking in.
So here's the bottom line. Credit risk and asymmetric information, they aren't bugs in the financial system that can be fixed. They're features. They are a built-in, unavoidable, fundamental part of banking. The entire business of finance, really, is just the art of managing this risk that you can never truly get rid of.
And that leaves us with one last big question to chew on. If this risk is a permanent, baked-in feature of every loan, every investment, every single financial deal, how does that constant uncertainty end up shaping our entire economy? How does it influence everything from interest rates to which businesses get to grow to the world we all live in? Something to think about. Thanks for joining us for this explainer.